Welcome to episode 5 of Bookkeeping for Small Business Owners. In this episode, we will officially learn how to record transactions, as well as what to do with those recordings once we have them written down. Specifically, we're going to talk about financial statements, as well as the books in the word bookkeeping, those being the general journal and the general ledger. Today's episode will also cover the late core knowledge layer of our pyramid of knowledge. First, hi, my name is Christian. I'm the owner and chief bookkeeper here at Vitality Bookkeeping. If you're interested in getting your books taken care of, I'd be happy to help. Just visit my website, vitalitybookkeeping.net. Up to this point, you've learned about the what, why, and most recently how of bookkeeping. Now let's learn the where of bookkeeping. Where do we put these transactions that we've recorded? In order to track how money flows through a business needs a centralized place to record all of their transactions, somewhere to officially recognize the transactions happened and to properly organize them. These centralized places are called the general journal and the general ledger. As mentioned earlier, in the word bookkeeping, these are the books that are being kept. You can think of the general journal and general ledger as the heart of a business's bookkeeping. Let's start with the general journal. The purpose of the general journal is simple. It's to keep a full and accurate official record of a business's transactions. The general journal does this by being where transactions are recorded in detail for the first time. This is why the general journal is also known as the book of original entry. So far, we've only talked about recording the account, debits, and credits of a transaction. To correctly journal a transaction, though, 2 more details are needed, making 5 in total. The 2 new details are date, the date the transaction happened, and description, why the transaction happened. So, in order to properly track how money flows through a business, we need to record transactions to the general journal. To properly journal a transaction, we need 5 details: the date, the account, the debits, the credits, and the description. It's worth noting that a 6th detail, called the journal reference number, is also used in accounting, but isn't universal in small businesses, so we'll stick to the 5 we just learned. All that said, once a transaction is journaled, it becomes a part of the official accounting records for the business, which will be used for taxes and other forms of legal compliance. Where a transaction is located in the general journal is referred to as its journal entry. The next question is then, where do I find the general journal for my business? If I start a business, how do I get my hands on a general journal? In a modern business, accounting software like QuickBooks Online will have a built-in general journal, which is where you would find it. If you don't use an accounting software, though, you can use a program like Excel, or you can quite literally just crack open a notebook and start journaling your transactions on paper. So, how do you properly journal a transaction? It's exactly the same way we've been doing transactions up to this point, except we format it properly and add a date and description. Different businesses will have different rules for their journal entries, but generally, they will look like this. Let's do an example. Transaction number 1. On August 14th, 2025, Cookies Galore spent $24 in cash to purchase a stack of printer paper. MAC. Money, $24. Accounts, supplies expense and cash. Change, debit supplies expense $24 and credit cash $24. Now, let's do the journal entry. I'll use Excel for this example. First, write out 4 columns: the date, the account, the debits, and the credits. Always start with the date. It's good practice to write out the full date. Here, this is 08/14/2025. After adding the date, we then add our accounts with their change. Very important. Always start with the debits and then do the credits. Left before right, like reading order. In this case, we debit supplies expense $24. The debit account is always entered without any indents or spacing. Then we enter the debit in the left column, because debits are always left. Then we enter the credit. Always indent the credit to make it easy to read. On paper, this is about a 1/2 inch into your notebook, and on a computer, you can just press tab or press the spacebar 4 times. Then we enter the credit in the right column, because credits are of course always on the right. The description goes in a line below the debits and credits, under the accounts column, and doesn't have an indent, just like the debit. And there you have it, a complete journal entry. Since there are a lot of formatting rules, let's journal one more transaction just to reinforce it. Transaction number 2. On August 19th, 2025, Cookies Galore took out a $10,000 loan from the bank for operating expenses. MAC. Money, $10,000. Accounts, cash and loans payable. Change, debit cash $10,000, credit loans payable $10,000. Journal entry. Date, August 19th, 2025. Debits, we put cash and then the amount. Credits, we indent and then we put the credit amount. Finally, the description. which does not have an indent. And just like that, that wraps up our section on the general journal. Once again, the general journal is where we officially record our transactions, in detail for the first time, so that we can have a full and accurate record of the flow of money in the business. In other words, every time you have a transaction, you write it in the journal to keep track of it. If you want more practice, I encourage you to look at some of the transactions in your business and then journal them manually. Let us now turn to the general ledger. Previously, we learned that transactions change account balances. We also learned that this change in account balances is how the flow of money is tracked in a business. Well, if the official way to record a transaction is by journaling it into the general journal, the official way to change an account balance is to post those journal entries to the general ledger. In other words, the purpose of the general ledger is to track every account and their associated balances. So, how does the general ledger work? In short, every time you journal a transaction, you then go to the general ledger and update the accounts that were changed in that transaction. For example, if you have a transaction where you debit cash $200 and credit sales revenue $200, you would journal that, then head over to the general ledger and update both of those accounts, debiting cash and crediting sales revenue balances by $200. In fact, that's how the general ledger works. It keeps track of every account in the business, the changes in these accounts, and the totals for these accounts. The process of transferring the journal entry into the general ledger is called posting. In other words, when a new transaction happens in your business, you first journal that transaction and then post that journal entry to the general ledger. As you might have guessed, this entry into the general ledger is called a ledger entry. The ledger entry includes all of the information from the journal entry and acts as a sort of archive as well as a running balance. Let's do an example using transaction number 2 from earlier. Recall that for transaction 2, we debited cash $10,000 and credited loans payable $10,000. In order to post it to the general ledger, we would open our general ledger and find the next available line to write on. Once there, we fill in the line with the date, account, description, debit, or credit, and then the running total. If you like, you can create subledgers specifically for each account in the business. In this case, though, we're only going to use a general ledger. To post transaction number 2, we open the ledger and fill in the relevant details, starting with the debit and then the credit. It'll look like this. Now, let's say there was a $1,000 payment on September 24th, 2025 that was journaled separately. $1,000 in cash was spent to pay off $100 in interest and $900 from the loan. Now, let's say there was a $1,000 payment on September 24th, 2025 that was journaled separately. $1,000 in cash was spent to pay off $100 in interest as well as $900 off the loan. Let's post it. Notice how the total is updated. If it's unclear whether the running total is a debit or a credit, just remember that the running total amounts are shown in the normal balance for that account. Likewise, just remember, if the general ledger is ever hard to read, you can simply create a T-chart to get a visual understanding of any particular account. Alright, believe it or not, after journaling your transactions and then posting them to the general ledger, you've completed the basic bookkeeping process. The gist of bookkeeping is looking into the bank and credit cards attached to your business, and then journaling and posting every transaction your business has. We still need to cover what you do with your bookkeeping, as well as how to properly do the full bookkeeping process from start to finish, but by knowing how to categorize and post your transactions, you've learned the basics of bookkeeping. Bookkeeping for your business, or as a service for someone else, doesn't end there though. If you remember in episode 1, we discussed why a business needs bookkeeping. There were a number of valuable reasons, but the most important reason was legal compliance. In order to be legally compliant as a small business owner, you need to produce financial statements. Financial statements report financial activity for a period. Financial statements are legally necessary because the law generally requires what's called adequate books and records, in addition to, of course, taxes. In short, financial statements turn your bookkeeping into useful information. There are a variety of financial statements that can be produced, but the income statement, sometimes called the profit and loss or the P&L, is the most crucial, as it provides the tax and regulatory information required for compliance. The next 2 most important statements after the income statement are the balance sheet and the statement of cash flows. Financial statements are standardized, so if you want to see a full list of options for financial statements, I encourage you to look up authoritative sources like the SEC. Before going further, let's recap the bookkeeping process so far. By the end of this course, we'll have a complete and comprehensive process, but for now, let's go through what you know so far. We know that bookkeeping is keeping track of how money flows through a business. We track the flow of money by recording transactions and updating accounts. We record transactions by correctly journaling them into the general journal. We update accounts by posting these journal entries into the general ledger. Then, we use the information from the general journal and general ledger to create financial statements. Business owners then use these financial statements to make decisions and stay legally compliant. Financial statements are the end goal of bookkeeping. This then raises the question, how do we create financial statements? The purpose of a financial statement is to turn bookkeeping data into useful information. To create a financial statement, we need to figure out what useful information we want. Then we gather that information from our general journal and general ledger to create a report. Now is a good time to point out the differences between creating a statement for a small business like yours and creating statements for public corporations and businesses making over $27 million per year, which we'll call large businesses. The key difference between creating financial statements for a small business compared to a large business is that large businesses are required by law to use accrual accounting and to follow what are called GAAP principles when they create their financial statements. As a small business owner, though, the requirements are significantly less stringent, as you only need to report to the IRS and not any major investors or the public at large. That said, as a small business owner, you'll still format your financial statements similarly to large businesses. You're just required to turn in less information. And yes, we will learn how to make statements that fulfill these requirements. So, with this long-winded introduction out of the way, let's learn how to create a financial statement. There isn't a perfect step-by-step process for creating financial statements because each of them requires different information. If I had to give a broad overview, though, the process would be this. Step 1. Determine which statement you want to create. Step 2. Gather the relevant information. Step 3. Compile this information into a statement. And Step 4. Finalize the statement and ensure everything is accurate. Step 1 is determining which statements you want to create. To figure this out, you need to know what information you're looking for. So, what information are we looking for? If you want to know how cash heavy or light you are, you would check the cash flow statement. If you want to see how owner's equity changed, you would look at the statement of retained earnings. As a small business owner, though, for tax purposes, you only need your revenue, expenses, and net income. In order to find these items, you need to create an income statement, which is the document I mentioned earlier, also called a P&L or profit and loss. Let's continue by focusing on creating an income statement specifically. So, for this example, we're looking for revenues, expenses, and net income. And to get that, we're going to create an income statement. Step 2. Step 2 in creating a financial statement is gathering the relevant information. To get the relevant information, you first need to know what each statement requires. You can find full statement requirements by checking authoritative sources like the SEC or FASB. Let's go over what the income statement requires. If you remember the accounting equation, assets equal liabilities plus owner's equity, you'll remember that revenues and expenses were subcategories of owner's equity. The purpose of the income statement is to subtract expenses from revenues to determine if there's an increase or decrease in the owner's equity for that period of time. Therefore, the relevant information for the income statement is the following: the time period, the revenue earned during that time period, and the expenses spent during that time period. Let's say we want to create an income statement for the month of August in 2025. Once we know the time period, we then collect all of the revenue and expense ledger entries from August 2025. Doing this is fairly straightforward. We just open our general ledger, start on August 1st, 2025, and then write down in a separate area all of the entries for revenues and expenses in the month of August through August 31st. This is part of what's called a trial balance, which we'll cover fully in episode 6. So after we've gathered all of this information, we move to step 3. Step 3. Compile the information into a statement. We know the purpose of an income statement is to identify all revenues and expenses for a business for a period of time, so that we can ultimately determine net income. Net income is, of course, determined by subtracting expenses from revenues. So to put this statement together, with the correct format, we would simply create 3 sections. At the top, a section for revenue, below that, a section for expenses, and below that, a line for net income. After we finish putting the statement together, we go to step 4. Step 4. Finalize the statement and make sure everything is accurate. After creating a statement, it's always good practice to look it over line by line and make sure everything is correct. Truth be told, there isn't a universal system for double checking, but here's a brief list of things to look over just to feel out if everything is correct. Dates. Make sure the period of time is correct. Format. Make sure it's easy to understand and that there's nothing throwing off the readability. Numbers. Make sure the numbers all sound right. You should have an idea of what the ballpark ranges for the various categories should be, so make sure everything fits, and of course, make sure everything is accurate. Ledger entries. It never hurts to skim over the ledger entries that make up the statement one last time just to make sure that every single one of them is on the statement and you didn't add or subtract any unnecessarily. Alright, once you've reviewed the statement, finalize it by putting it in a shareable format, like a PDF if it's online, or a folder if it's physical. Then, if you need it for anything, you can easily send it to wherever it needs to go. With that, You now have an understanding of how to create financial statements. One more time, the steps are: Step 1, determine which statement you want to create. Step 2, gather the relevant information. Step 3, compile this information into a statement. And Step 4, finalize the statement and ensure everything is accurate. All right, that wraps up today's episode. We learned about the books in bookkeeping, which are the general journal and general ledger, as well as what to do with the information in them, by learning how to create financial statements. Next episode, we reach the finish line. We'll round out the crash course by going over the capstone of our pyramid, which includes both the accounting cycle and the bookkeeping cycle. That said, if you have anything on your mind or you have any questions, go ahead and leave a comment. If you're interested in getting your books taken care of, I'd be happy to help. Visit vitalitybookkeeping.net. Otherwise, thank you for watching, and I'll see you in episode 6.